Great. Okay, welcome everyone. We'll get started now. I am David Myers. I'm the Executive Director of the Conservation Finance Alliance, and we're thrilled to have a really interesting panel here. This builds on a discussion series that we've been having, focusing on COVID-19 and the conservation finance community. And not too long ago, we did sort of an online poll looking at all the different types of conservation finance mechanisms that we've elaborated in the CFA white paper, conservation finance framework. And a few different mechanisms really came out as basically least affected by the current coronavirus pandemic that's affecting the world. And that included public-private partnerships, government funding, and blended finance, and we are really excited to focus this on blended finance. Not only is it one of the mechanisms that seems to be resilient in light of coronavirus, but it's really a mechanism that is being more and more recognized as something that's extremely valuable in the field, and one where there's more and more innovation surrounding it. So we're really fortunate to have three amazing panelists today. We have Aditya Gupta, Gregory Watson, and Avril Benjamin. Aditi is from Convergence. Convergence is, well, Aditi will tell you all about Convergence and the data that they have, but Aditi's been working in this space for a bit. She's the manager of the she's manager at Convergence, and I just seem to have lost all my notes here, but that's okay. And Gregory Watson is running the Inter-American Development Bank's Natural Capital Lab, which is a really innovative approach to try to bring in natural capital and exploring more innovative approaches to financing. And Avril Benjamin is the heading the blended finance initiative of the Global Environment Facility, and they will all sort of introduce you to their different organizations and the work that they do. We're going to have Aditi start with a brief introduction about what blended finance is and what Convergence does, and then we're going to kind of have a back and forth discussion with the panelists, and after that we will open the floor up to questions from the audience. And from the audience, what you need to do is type your questions into the chat box, and then we'll be going through those questions and calling on you to unmute yourself when the time comes and ask the questions directly, or we'll just read the questions off depending on how the timing goes. And so without further ado, I'm going to pass it over to Aditi, and I'd like to hear about blended finance and Convergence. So Aditi, over to you.
Thank you, David, and thanks for having me here. I am looking forward to our discussion today. I lead the Market Acceleration and Design Funding Program at Convergence. Convergence is the global network for blended finance. We generate blended finance data, intelligence, and deal flow to increase private sector investment in developing markets. Before I dive in, a quick introduction on blended finance for those in the audience who may not be as familiar. Blended finance is a structuring approach where different types of capital sit together in a financial transaction. So we see it as the strategic use of catalytic capital, that is capital which is below market rate return seeking. It could be catalytic capital could come from public or philanthropic sources, and use of this catalytic capital to mobilize private sector investment towards the SDGs. As David mentioned, blended finance is one of the approaches that can be used to attract additional sources of capital to conservation. And I wanted to share with all of you a couple of data points from our historical deals database. So on conservation in emerging markets specifically, we've seen that there have been over 30 blended finance transactions that have closed and have received aggregate financing of over $3 billion. In terms of regional breakdown, we've seen that historically blending for conservation has been most common in Latin America and Caribbean, and I'm sure we'll be hearing about that from Greg a little bit as well. So our data shows that blended finance is not new to conservation, and there is a growing body of transactions that can be used to refine and scale solutions. But when we talk about scaling in this environment, we have to recognize that we are living in the midst of a pandemic, which has been a massive health and humanitarian crisis. And it's also been a major shock to the system. And when there's a shock to the system, investment shuts down, not only because of increased actual or perceived risk in investing per se, but because investors are not able to size up and price this new level of risk. And addressing this risk is going to be hugely catalytic in getting private sector investment flowing once again. And blended finance, that's why, is well positioned here and resilient in the face of the pandemic, because risk mitigation tools like guarantees, first loss protection, off-taker commitments can all be very powerful in addressing this risk. And that is what blended finance is all about. And even prior to the pandemic, we've seen that conservation and blended finance transactions in conservation specifically often rely on multiple forms of concessional capital. Specifically, our data has shown that design stage grants, that are grants that come in prior to the launch of the transaction, have been key for conservation projects. Transactions for conservation have been nearly twice as likely to benefit from design stage grants as compared to other blended finance transactions. Convergence has recognized the importance of design stage grants as a market acceleration opportunity, and we provide design stage funding to practitioners to secure feasibility study and proof of concept funding to develop and launch blended finance vehicles. Historically, we've operated the global emerging markets window that was providing design funding across sectors and across emerging markets. And specific to conservation, in 2019, we launched the Asia Natural Capital window, which, as the name suggests, focuses on design funding for nature-based solutions in Asia. To share a couple of examples where design funding has been very successful and has shown the value is some transactions that some of you may be familiar with. There's a tropical landscape finance facility in Indonesia, debt for nature swaps for marine conservation. And one example in particular I want to take here is Clermondial's Food Security Fund. This is an open-ended investment fund for private credit in agriculture. And the reason I take this example is to show you where in the transaction design funding can be valuable. And here, Convergence gave a proof of concept grant in 2017. And 2 years later, the Food Security Fund was approved by the GEF Council in 2019. And so that's to show you sort of how that spectrum looks like. And I will end here, and I'm sure we'll be hearing more about Jeff from Avril.
Thank you very much. Can you hear me well? I hope.
Yes, we can. We can.
Good.
Thanks, Avril. Over to you.
Good morning, everybody, and thank you for joining us for this very exciting panel. I actually just, as Aditi was speaking, I thought to maybe share my screen, if that is possible, to show some data, but if not possible, because I didn't tell the organizers, that's totally fine. I can actually mention what I wanted to say in speaking. So
you can share your screen, Avril. Yeah.
I can. Okay. It says this will stop others to share screening. So I hope
that's okay.
That's okay. Okay. So we're getting here. So I hope you can see what I'm going to show you in this slide. So as David mentioned at the beginning, I lead the blended finance initiative at the Global Environmental Facility. As you may know, the GEF, or GEF, depends on who is talking, was created in 1992 at the Rio Convention, at the auspices of the Rio Convention. And since then, we've been basically the financing mechanism of multilateral agreement on the environment conventions, namely the UNFCCC, the UNCCD, and also the Convention on Biological Diversity. What's interesting here is on showing this slide is that indeed blended finance has been around for a while. As you see, since 1992, we've been doing these type of projects. But as you can see, most of this historically has been focusing on energy and what we call sustainable cities, so climate change mitigation, until we reached what we call GEF-6, which is, well, as a fund, we get replenished every 4 years. And in the replenishment of GEF-6, you can see a little bit more emphasis in land use and biodiversity and sustainable fisheries. As we're in 2020, we're currently in GEF-7. So I now lead a portfolio of $136 million to be invested in blended finance projects. What we try to do, as very well Aditi mentioned, is to provide catalytic finance or instruments that can bring in private sector investment to invest in areas that are not ready for commercial finance alone. We do so basically by doing open call for proposals, and we select projects based on a competitive process. And the data I'm going to show you in the next 2 slides, I think can be interesting to you. If I can, there you go. From GEF-3 to GEF-6, which means from early 2000s to 2014, as you can see, the types of projects that were supported by the blended finance initiative at the GEF were very well distributed geographically. And most of them, and that's important, I would say, were requiring equity. Equity as it seems to be the type of instrument that blended finance structures were looking at or required mostly, just because I would say it's usually higher risk. It's prone to be invested in higher risky transactions. By focal area, the focal area is the way we talk at the GEF of the different areas in the environment, and we basically have 5: climate change, land degradation, biodiversity, and then we have other 2 that are called chemicals and waste and international waters. And as you can see in these dates, most of the demand and most of the investment in blended finance went to climate change, and in other areas touching up on multifocal areas. So that means climate change plus biodiversity or climate change plus land degradation, etc. Since GEF-7 started, which was 2017, right now, 2018, and we're in the middle at the equator of that 4-year replenishment cycle, we've received, as I mentioned earlier, a high demand for the blended finance portfolio. We're seeing more and more global initiatives instead of regional initiatives. Equity still continues to be the highest demanded product. And by focal area, and I think this is very interesting, we see that climate change mitigation only, so as a single focal area, has been reduced from almost 45% of the portfolio in previous GEF cycles to 15%. And we are now more in a multifocal area world. What does that mean? It means that what we're seeing in blended finance that is actually good news for conservation is that we're having design of projects that not only focus on climate change mitigation, but on the frontier overlap areas that biodiversity, land degradation, climate change mitigation, and even chemicals and waste lie into. And this is a very exciting development because we think that's how basically investment is going to turn into more biodiversity and nature. And so just a couple of more, I want to exit my screening. just a couple of more, if I can here, stop share. Okay, so I wanted to share just a couple of data with you. The portfolio we have is 136 million for this current cycle. We've launched 2 calls for proposals so far, and we're in the midst of the third. And in 2 calls for proposals, basically we received already 3 times the amount that is available to be invested. So that means that private sector investment is ready and looking for these opportunities. But of course, and as Aditi was mentioning, they need risk mitigation products. They need blended finance structures that will help them close the financing gap in these challenging conservation areas. And I will stop here to give the word out to Greg.
Thanks, Avril. Over to you, Greg.
Thanks, David, and thanks everybody else. It's a pleasure to be here with old and new friends. I hope you're hearing me well. I think it's interesting to talk a little bit about the IDB's evolution in this topic and how I got to where I am in the IDB. The IDB's been, I think, pretty active in natural capital and biodiversity finance over the years. And through the different parts of the IDB group, through the private sector windows, through the public sector windows, and talking about this topic of blended finance is a bit challenging because there's, I think, so much richness in an MDB. I mean, we're working on the policy framework, we're working on individual transactions with large corporates, with you know, kind of startup financing. I think the IDB is pretty well known for doing impact investing in this sector. So getting your arms around the whole thing is a bit challenging. The reason that President Moreno basically decided to create the Natural Capital Lab in 2019 was because we did have these different sets of people working on these different topics, but in many cases, and I was one of them in the IDB lab at the time, in isolation without a kind of overall umbrella approach. And because of the nature of these kinds of transactions, they really require an integrated, holistic approach within an institution like the IDB, where a client can come and you're actually bringing together multiple different teams from across different thematic sectors, different financing sectors to put a project together. So that's why in 2019, we created the IDB's Natural Capital Lab. It's basically a one-stop shop inside the IDB to fill the financing gap in biodiversity finance and to mainstream biodiversity and natural capital across countries, the private sector, and within the bank, and to create that place for all of these actors to come together. And why do I emphasize that? It's because while the individual transactions are really interesting, and I hope, and then I am going to talk about some of that in some of the later questions, I think the enabling framework is also really important. You know, and bringing the partners together in any one of these transactions, I think has been what has made some of these hard to do in the past, because you're not all speaking the same language. You know, the conservation organization is writing a 100-page scientific document that a CEO is not going to read because they want a 2-page summary memo, that a policymaker, you know, wants something that explains the full range of benefits for their sector, and you need somebody that's going to intermediate all of those conversations. I work across, like I said, IDB, IDB Invest, IDB Lab. We're managing funds from the government of France, from the government of UK, from the GEF, totaling about $60 million to use for blended finance. They're open to any part of the bank, and all the projects that I do are in partnership with different bank sectors. Occasionally, I'll do projects directly myself to incubate really interesting early stage ideas with some grants, but usually my team is working with other parts of the bank to get ideas off the ground. The thesis is basically, and everybody I think probably in this call knows these numbers from the McKinsey study, that, you know, conservation restoration projects need $400 billion a year. They're only receiving 50 billion, and it's mainly public finance and philanthropy. There's some private. How are we going to fill that gap? It's going to be through more efficient use of the public resources that are out there. It's going to be by carving out and mainstreaming the topic of natural capital within nature-based solutions in the Ministry of Ministry of Public Works, which requires a whole lot of work with the private sector, with engineering firms and toolkits, but it's also crowding in private finance. And so that's what we're doing. We're creating kind of incubating those early stage, real revolutionary concepts and ideas that are new kinds of finance. And I think one of the things that we see at IDB is that it's a lot, we need to go far beyond the traditional guarantee debt equity structures. There's a lot of more innovative finance that we can be doing. Simple agreements for future equity, much more risk capital out there that we should be trying to pilot, capital market structures. And so I can talk about some of those deals, and I would really like to talk about some of those deals in some of the questions. And so, concretely, I'll just close. Some of the projects we're working on right now are accelerators with risk capital, working with second-tier national banks to create bioeconomy funds through SPV structures that will invest in a whole range of businesses, working to create basically a capital market structure where you can do an IPO of the value of nature on a stock exchange, working on insurance mechanisms, and in some of the later questions, I think we can get into the details of those transactions, which would be, I think, interesting for the group.
Great. Well, thanks everyone for your introductions. Obviously, this is because blended finance involves public and private financing and a combination of tools. It can be quite a complex area, but it's, in a way, it's been around for quite some time. So maybe just a general question: what are the more innovative or exciting new mechanisms that you're seeing that are creating the right environment for the private sector to come in and contribute to nature conservation? And I think that I think a lot of these tools are essential given the kind of underlying structural challenges that exist for private investment in nature. Like if you want to keep a forest intact, it's hard to get the private sector to invest in not cutting down trees. So it's a real different approach for nature compared to, say, renewable energy. So what are some of the sort of innovative revenue sources that are being used to pay back the private sector, and what are some of the more innovative tools that you're seeing emerging in the blended finance arena? Any open to anyone?
Well, I may take this one. To start with, I think Greg just mentioned very exciting new developments, both in capital markets and also, he was also mentioning new types of agreements that are kind of flexible arrangements that would help accommodate the realities of investing in conservation and biodiversity. But I might take a step back to say that for me, what's new, and we can discuss new type of transactions, but for me, what's new is the increased awareness of financial actors in the financial industry, not only on climate, but also on nature risks. I don't think this is only a consequence of COVID-19, but I think COVID-19 made even a higher emphasis in the need to basically include in nature as part of, in a sustainable manner, in the way we consume and in our economic models. I would say that increased awareness for the listeners who are not familiar with financial news all the time, come from major financial institutions, asset managers, the guys who basically manage and invest the pension funds for all of us, to acknowledge that investments in sustainable companies is not only better for the environment, but also less risky for the investors. This is what we call now the ESG investment and products, unfortunately, and I will say this, it's a good development, but on conservation specifically, it's an area that is very underdeveloped, and most of it is because we're lacking metrics, we're lacking track records, we're lacking a way of saying how, you know, as compared to carbon or climate change, for example, we can have pretty easily, or there are approved methodologies to have the equivalent on GHG avoidance for a given investment. When we're talking about conservation and nature, unfortunately, it's a very local, and I'm saying unfortunately from a standardization point of view or from a risk return point of view for investors, it's very difficult to measure what is the price. If there's no measure for the price, but there's not even measurement for risk of a given investment in a given geography at a certain point of the geography. So we're lacking that aspect first on the measurement and the indicators, and then I think we can start bringing that to the investors who are now seeing or are now looking for investing in climate friendly and hopefully very soon also nature-friendly companies. The second thing that we're seeing that is new, and it's still limited, but it's a good development, is the will of policymakers to basically take into account nature as part of the economies. And we're seeing that in the European Green Deal, which is including policies that include biodiversity, at least in a common agricultural policy. And I think that that's a beginning. It's not enough, but it's a beginning, and it's pretty new. So that said, once we get investors' interest and policymakers' will, we are now seeing that we can use financial structures also to help address this lack of track record and the lack of risk assessment. Because if we have no idea of what investing in a given forest or protected area in Suriname, and I think Greg can speak to that example after me, we cannot price it and we cannot sell it to investors, and therefore private sector investment will be constrained as long as we don't have these two aspects of risk and return clear in our minds. And I don't know if Greg wants to take it from there.
Yeah, I mean, I'm kind of stepping on what I was going to answer in a later question, but I'll go through 3 deals quickly that I think answer your question, David, and that give some specifics. So on the first is something that Avril just mentioned, which we're working on in Costa Rica and in Suriname, which should go active, I think, kind of end of summer, early fall. And this is the intrinsic value exchange, where we invested close to $1 million in the form of a contingent recovery grant. So it's kind of a quasi-equity structure where, you know, upon reaching certain milestones, our contribution converts into an investment along with, you know, other investors when the deal basically becomes, when the underlying entity, you know, goes to the market. And so it's a way to basically take a lot of risk in the early stage, but simple agreement for future equity, basically. What the deal does, though, is, and it can work both in a you know, national protected area, but also on productive private held lands, which is what we're doing in Costa Rica. You basically create a trust company that values the natural capital of something, right? It could be oceans. In these cases, it's terrestrial, and you can include or exclude whatever natural capital value streams you like. So if the carbon's already spoken for, you could exclude it, and then you actually, we're currently in discussions with FASB, the accounting regulator, and with the SEC. So you in the accounting framework of that trust company, the natural capital value streams, you know, are accounted for through an accounting methodology, which is currently being approved. And then you do an IPO of the value of that natural capital. And the natural capital, the underlying land is not actually transferred. It's almost, think about it as air rights, almost like over a building. And then that is floated in a stock exchange. And you know, you obviously have the natural capital valuations that underlie that value, and you have different, you know, calculations there that you publicly share in the prospectus. and you let the market basically start to both set a price and also trade that value. And when you do the issuance, you know, a certain amount of those shares are owned by the trust company. A certain amount can be, you know, if it's a public land, distributed to the government, to indigenous populations that may live in or around the area. And so a locked asset that, you know, as of today could be zero, it, you know, has a value. Now, you know, on day one, it's not going to reach the value that you probably have in your prospectus, but over time, we think that there is quite a market there. And so, you know, these are the inventive structures that we think could potentially be transformational, and we should at least be trying, right? Especially as a public institution that has public money to be trying new things. And I can tell you that one of the largest multinational agro-food companies in the world is actually partnering with this exchange right now on their the kind of the plus of the biodiversity of their good practices in agriculture to do an offering, and so on the exchange. So it's something that I think is going to take flight. Another is, you know, we invested $1 million in a habitat bank in Colombia, the first in Latin America, which creates offset credits for biodiversity. So, you know, if it's a standard, you know, mitigation hierarchy, which is required in Colombia, but if you cause damages, you have to compensate in a similar ecosystem. Rather than having a, you know, oil company or pipeline company do that on their own, they can actually buy credits, you know, quote unquote credits, that are done by a habitat bank operator who has already found a degraded land, started activities, monitor them for 30 years. It's lower cost than if the company had done it on its own, you know, the oil company. We've had 2 transactions through that bank already. They're ready to start paying back the IDB as an investor in that transaction. And you could easily see how you could create a kind of second tier fund that would invest in multiple habitat banks and be paid back. And then the last one that I wanted to mention is, you know, we're starting to do some work as well with the different insurance companies on insuring natural assets as infrastructure. And so I know TNC has done this in Quintana Roo. We're looking at doing this with insurance companies with the MAR region. And so, you know, we see that as also another potential way to drive investment into these different sectors. And there's some other examples I can talk about later, but I wanted to kind of throw a few out there.
Excellent, great. Well, some really innovative approaches here. So just Greg, for clarity's sake, when you doing an IPO for natural capital, that the person who owns a share of that has rights to future value of the ecosystem services that natural capital provides? Is that how that works? Is it?
It's basically, think about it as, I mean, it's basically like a derivative. So, I mean, think of it, it's the same as if you were, I hesitate to use Bitcoin as an example now, but it's, you know, it's a stored value transaction, right? And so people are storing value in gold, and people are storing value in art. People are storing value in other securities. And so you can store value in a share of the natural capital of the rainforest, and you can go on Google Earth and you can see that stored value. So it's not that you have a right to go and chop down, you know, your share of the forest, right? You have a share of the ecosystem service value, but it does, you know, you have a share of the company that owns that value stream. So it's like a derivative of that ecosystem service.
Right. Well, very, very interesting. Thanks so much for those examples, and I'd love to hear more in the future. Aditi, maybe could you? There was a question early on. Just maybe if you take just a minute or so to give people a bit of a more of a briefer on how blended finance works, a briefing, sorry, and then just and it'd be great to know, like, sort of, you know, what you're finding with your design phase investments, and what are some of the innovations that are coming out of there?
Sure, David, happy to. So like I had mentioned, the Asia Natural Capital Design Funding window we have right now It is open for applications. We accept applications on a rolling basis from any practitioners in the space, and we're really looking for solutions that can attract private capital at scale. Maybe I'll take an example of one of the solutions that we funded very recently, and it was one of our first grants from the window, was the design of a sustainable seafood fisheries financing mechanism that is being led by Ocean Outcomes. And what we found interesting here was that they're looking to find a different way of financing fisheries improvements projects. As we know, fishery improvement projects have traditionally been grant funded. They often don't have funding to support that long-term impact in the water. And what Ocean Outcomes is looking to do is structure a financing mechanism where this funding is actually coming through a commercial investment from the seafood industry and through the seafood supply chain. So it's still early days. It's a feasibility study, but that is something that we are very excited about. And also reflecting on the theme of innovation, and I think this is one of the questions that came through the chat box as well, on balancing innovation and standardization. And I think that's an interesting one to explore, because at Convergence we found that financial innovation for innovation's sake is not useful. And when you're looking to attract the private sector at scale, if you can standardize and do the same deal again and again, that's great, that's perfect. If you can use a vanilla structure, but there are cases where you can't. So I think that is a theme that is worth exploring more, and maybe Greg and Avril also have some comments on that. One thing which we found really useful in and an approach we are supporting through our design funding window is aggregation, especially in conservation projects. We found that individual projects are often too small to attract investment. Due diligence cost itself for investors can be really high. So we have supported one blue finance facility, which is looking to aggregate investments in marine protected areas. They had a pilot in the Dominican Republic, and they're looking to replicate in Southeast Asia and see how you can aggregate. So I think pooling in conservation can be a really powerful tool as well.
Excellent. Some really interesting points there. And I mean, yeah, one of the big challenges with private investment that we're seeing for nature is that the deals are small. The deals are small. They tend to be, in areas without the sort of in areas of relatively high risk, and so the reward to risk ratio is just not interesting for the private sector, especially given high transaction costs. So pooling is a great opportunity, and trying to get to that scale is something really what blended finance can help. It seems that it does that mostly through intermediaries, so which is interesting. Let's see, so people are starting to put in some questions. I highly recommend that, and I see some of the panelists are responding directly online. And let me just get back to Avril here. The GEF is that you're looking at your numbers. Your sort of average deal size seems to be around 8 million or so, if I'm got that right. So those are on the kind of larger size. How are you what kind of deals are you seeing? And how might you be working with some of these other partners here to build up the ecosystem for blended finance, sort of get those early deals up to the level of where GEF is able to invest in them?
Yes, thank you for the question. I think it's also related to one of the questions that was in the chat. So listen, the GEF works through blended finance with blended finance in bigger deals, as you say, that are a little bit more mature than what a design grant like IDTs or IDBs type, some type of projects can do. Although it's important to say that we have supported the design of some conservation funds like the N Green Fund through grants. So we can do that on a case-by-case basis and in types of transactions that we truly believe in. And that was also, not only we can support through grants this type of projects, but also we are very active in partnerships. As you know, we are at the inception of the CPIC coalition, and we want to fund through the CPIC coalition a pipeline of projects that would come to the CPIC coalition as part of their activity and mission, which is basically accelerate investment in conservation. What we see at the GEF, there's differences in sizes depending on the GEF cycle. I would say that's also because, initially when we were doing blended finance, it was more climate change type of projects, project finance for clean energy mostly. And those were bigger because they were bigger. At the time, we used to also finance on-grid types of projects when we needed to prove the technology and, make this as a type of energy source that would be explored once at some point. It wasn't really financed by governments or other types of financiers alone. So we wanted to prove that. At the time, sizes of deals were bigger. When we're talking about conservation examples, we see smaller scale for sure, but we focus on investing through the blended finance window in types of structures that can be scalable and replicable. And I go back to a point made by Aditi before and also by Greg, which is how can we be innovative at the same time as creating a type of product that has the risk and return profile that investors can use. And here, I wanted to share a project that has been recently approved by the GEF Council, which is a wildlife conservation bond. It's a bond that is basically designed to invest in conservation efforts of the rhino population of 2 parks in South Africa. So how does that work? And why do we think financial products in combining both public money or threefold sources of financing, which is public money, philanthropic money like ours, and also private sector investment, we can reach a risk return profile for conservation activities that can be marketable in securities market and also reach risk return profiles that are acceptable and will have demand from this type of investors. And how does that work? Here, the combination of these 3 sources of finance achieves to have a AAA rating by the bond, which for people in the audience that are not familiar with that, it means that you cannot get any higher credit rating score. Like it's like as if you had your FICO score in the US being above 800. It's like you're super reliable on credit repayment. And at the same time, we combine that very good credit rating with a performance-based coupon. So the way the bond would work is that if the conservation activities are successful, then the bond will pay a coupon. If the conservation activities are not successful and therefore the rhino population does not increase or decreases, then the investors will receive back the principal. That's why you have the AAA rating that is very important, but won't receive any coupon. The way the structure works is that the World Bank Group is the issuer. So there you go. That's the AAA rating that you need. The investors investing in the bond, mostly impact investors, I would say not yet the type of big pension funds and asset managers, because they don't have yet the teams to assess the type of risk of investing in this type of products, but still impact investors, family offices, we think, and some other types of maybe financial intermediaries that are not highly regulated for now. And that these investors would somehow give up the possibility of receiving what the World Bank Group bond would give as a normal coupon. So imagine like in the realms of 2-3% per year, or less now that interest rates are so low. And they give up that option to instead receive a performance-based coupon at the end of the bond if conservation is successful. So basically here, the beauty of the structure is that the investors are also putting skin in the game. They are saying, I'm willing to take the risk of not receiving any coupon at the end if conservation activities are not successful, but the money that they forgive, so this coupon, these 2% annually, these 2-3% annually, that money is invested in the conservation activities in the two parks. So there you go. There you have the investors willing to invest directly in conservation activities in the ground. We, as the philanthropic source of financing, are willing to pay this performance-based coupon at the end, and then the World Bank Group, as an issuer, can give a AAA rating to the bond. So I think that's something that we're very excited about, and we think could be replicable. Here, the question, or the very important aspect, is who is in charge of the conservation activities? How are you going to measure rhino population, and based on which types of conservation activity? And so local capacity of these types of initiatives on the conservation side, not on the financial side, is key.
I'd love to jump in on that.
Sure.
Actually,
Please.
you and I
had a question too. So
really, you and I actually haven't had a chance to talk about this, and which is funny. But you know, we at IDB have been working for a while now on similar structure for a Jaguar bond. You know, to cover the Jaguar corridor with partners like Panthera, with partners like the government of Costa Rica, but also with other regional governments, where it's a similar spin, but actually incorporate not with national parks, but with actually privately held productive lands, where you know, a lot of the issue is actually, you know, jaguar habitat that covers you know, agricultural lands. And so the activities that you need to do are, you know, putting in you know, walkways or corridors, or, you know, so that the jaguar can actually still continue its roaming. It's a slightly different kind of model. But it's something that we've been looking at too. And then the other thing that you make me think of is going back to the idea of debt for nature swaps, and you know, we're going back to the COVID topic of this of this panel. You know, we're entering this period of economic uncertainty in many of our countries in Latin America and the Caribbean. I mean, President Moreno and Hank Paulson just wrote an article 2 days ago about this, that we have huge debt burdens. They're increasing. We're probably going to see debt restructurings, maybe debt for nature swaps. Their time is coming back, and this idea. One of the things that we're thinking about setting up, and in the process of setting up, are kind of a window to support these debt for nature swaps with these kinds of coupons that can, you know, results-based payment coupons as well, just like you just described for the Rhino bond, that could actually support these debt restructurings too, where you know, you could set up almost the exact same structure to support these debt restructurings, and you could issue new bonds, you know, to help a country restructure its debt, where a portion of the proceeds are going to nature projects, and you could have a you know, a grant that's used to basically do a results payment, you know, to sweeten the deal a bit as well. And so that's something that we're spending a lot of time looking at as a structure too. And I wanted to mention, just if I can, David, one other model that, you know, we think is really important in the post-COVID time. We were working on it before in Peru, and that's kind of structuring large national scale bioeconomy investment funds that can crowd in private investors. And we had started this in Peru, you know, at the beginning of the year with COFIDE, the second tier bank, the financial institution, where the IDB would lend $20 million. We would provide about $5 million worth of grants. And the target size is a $50 million investment fund and you create a special purpose vehicle in a country that the second tier bank basically supports. But that SPV can do everything from equity to lending guarantees to banks, to cooperatives, to microfinance institutions, to support bioeconomy businesses. We did a lot of visits to different Amazon regions in Peru, to all the different kinds of businesses that could be supported. when COVID hit, we were wondering whether or not the government would still want to move forward with this kind of program. And actually, they called us up and said they've prioritized the project even higher because they see that in the post-COVID landscape, restarting the economies of these geographic regions is going to be incredibly important, and that they see the bioeconomy as the way to do this. And we've actually had significant interest from other countries in this model as well. So it's kind of becoming a standard product offering that we're now doing. And then the other half of this is that by creating this kind of blended finance structure where you have, you know, a loan, or it could be a guarantee that, you know, the country doesn't need to take a loan from the IDB. In some cases, it could be a guarantee, plus some grant money, which actually provides for the extension services on the ground, the monitoring and impact framework, the, you know, verifying the environmental benefits, but most of it's going to actually the extension services. A small amount, like 2 million, to actually sweeten the terms for the individual companies, allows us to then create this like $20 million fund that the other half is us reaching out to the investors that are out there, either corporate investors or the investment funds, to crowd in that other 30 million. And we have interest from the private sector to come in on these kinds of funds because they see it as very attractive in terms of the return that they can get, because you are investing in, and different, you know, you create the different sectors depending on the country, but we're looking at timber and non-timber forest products, reforestation, you know, aquaculture within very, very, very defined terms, you know, to make sure that it's the right kind of aquaculture. It's aquaculture that actually is reducing pressure on native species and only with native species. You know, but you go through this whole list that's very much in line with what the government's priorities are for restoration. And so I think that's another interesting structure that's out there that is very emergent in our region.
Yeah, I mean, the eco business fund, I mean, the idea of working through intermediaries and getting them to
but this is much larger scale than like eco enterprises, or, you know, this is because we helped create eco enterprises and those kinds of funds, and those are, you know, like doing much smaller scale investments. These are going to be much larger in terms of the ultimate impact.
So, Greg, I have a sort of a follow-up question, but I think it's really open for everyone. And please, folks, do raise your hand or put in a question if you'd like to ask. But you know, the concept of blended finance, as you say, is crowding in the private sector, creating the conditions that make private sector investments more compatible with their expectations in terms of return and risk. Is this, and it's, of course, it's a great thing for banks and donors and governments to do to move the money. Is this something that we're going to have to keep doing, keep sweetening the pot for a long, long time? Or does anyone think that the learning that the private sector is going through by participating in these types of blended finance deals will be enough ultimately to create, let's say, purely private investable deals? And maybe there's a couple of examples where we've seen that evolution, so that we don't always have to, you know, blend the public with the private. Any people interested in any thoughts on that?
David, I can start there. I think it's a mix of both. I think in some sectors, in some areas where it's really nascent, the underlying business model itself is difficult. You will continue to need some form of concessionality. It might reduce over time. But when you talk about mitigating risk, I think where blended finance can be phased over time is when you're dealing with perceived risk. And you know, I think guarantees is a good example of that. If you have a guarantee from a DFI or an MDB, and the project is successful, the guarantee doesn't need to be drawn down. The next time over, you've given confidence to the private sector. But if the underlying revenue model itself is problematic, the investors can't do a good risk return analysis on it, then it becomes difficult. I think the debt for nature swaps are a good example of replicability. So the first debt for nature swap that was done with Seychelles, they just came a full circle in it. And Seychelles has exceeded its target of putting 30% of its area under conservation and gone up to 32%, and the debt for nature swap was successful. But TNC, who was the intermediary in this that transaction, is looking to replicate that structure in many other small island developing states or coastal countries. And what they're doing for the next round is the Seychelles transaction was quite small relatively. It was $25 million, but they're looking to see how they can raise larger commercial capital, not have that much grant, because you've proven out the model. And like Greg was saying, I think the other benefit of this model is that not only is it drawing money towards conservation, but it is also creating fiscal space for the government, which is, as we all know, is very important here.
Great, thanks. Yeah, Rob Weary and the TNC team are really, this is hitting in a very interesting time given the COVID and everything too. So we're running out of time here, but maybe if you all could give me sort of a final departing thought of the future of blended finance. And Aditi, maybe we'll just start with you since you're there. I gave you no time to think.
I think the blended finance field is evolving really quickly. As we discussed, blended finance has been happening for a while, but the nomenclature and calling it, looking at the evidence base, seeing how people have done it, that's a fairly recent trend that has happened in 4 or 5 years. I think that there's a lot of potential for the field, but the eventual aim is, we're all targeting SDGs 2030. And hopefully we can get there with blended finance.
Great, thanks. Greg, yep, next.
Yeah, sure. I mean, I mean, answering your former question and this one at the same time, I think, like, we just saw there was a hedge fund that just announced they want to put $1 billion, right, into nature, biodiversity, and the climate intersection. So, I think the private sector is coming. I think where blended finance needs to go personally is there's a real lack of money on the early stage where it's like, we need to see 1,000 flowers bloom in terms of, like, get over our fear of just testing a whole bunch of different things, and some of them aren't going to work, and that's fine, and we need a lot of early stage risk loving money to try stuff. And if some of it doesn't work, let's learn from it. So I think we need to focus more on that part. And then I think we need to focus more on where we can enable, when we do have models that work, like these large scale transactions at scale, like we're trying to do with these bioeconomy funds, where we can create national level, structures that can channel huge amounts of money into different programs, or these debt for nature swaps, so maybe we get out of this business of these mid-range transactions where it's like a loan here, a guarantee there, and we focus more on those two sides.
Excellent, thanks. Avril, over to you for a final word.
So about the future, I would narrow down a little bit my answer for blended finance for conservation. Blended finance, I think, will still, in general terms, be a useful tool of the toolkit that will bring us to create the track record necessary, and have things that were not financed before and projects to be financed. In conservation specifically, I'm very hopeful about 2 developments. One is the TNFD. I think someone made a comment in the chat. The TNFD, for those who are not aware about it, is a framework that has been recently launched, July 21. Actually, there's a working group to launch the task force for nature disclosure, which is similar, or I would say follows the same line of thinking than the TCFD, which has proven to be a game changer for the financial industry. I think the TNFD won't really provide a pricing for nature, but it will help measure risks and impact, and have these unseen good be part of our economy, make something that is unseen and invisible seen and visible from a risk perspective, unfortunately, and not from a pricing perspective, which, Greg mentioned some some ways to have a pricing through the exchange, the stock exchange that he is supporting, or the IDB is supporting. So I'm hopeful that TNFD will create big traction on financial institutions' awareness and manpower and brain power to put nature as part of their financial considerations, and I'm hopeful about that. And the second thing is about financial products that combined very good rating. So how can we create for now with blended finance projects that bring in the big money? So the people who are there, you know, the big pension funds, the big asset managers, and to do that, you know, types of structures like the wildlife conservation bond we just supported, or the Jaguar bond, or others, in which you can have the combination of the three, the partnership of the three, can make at least you know, new type of product that can unleash funds at a bigger scale. And that's what we need. We need bigger scale soon, sooner rather than later. So that's my two, I would say, my two reflections on blended finance for conservation and the future.
Well, thank you, Avril. Thank you, Greg and Aditi. Really, really interesting topics for folks that want to continue. I think you've put forward all your contact information here, and people can get in touch with you. But just really interesting topic, and it was great to hear from you all, and very excited by what you're doing, and wish you all the best of luck as you move forward and develop these areas. So thanks everyone for listening, and thank you to a great panel.
Thanks, David. Thanks, everyone.
David.
Thank you.